financial crisis of 2008 is exactly what it is called, a financial crisis. Even though many economists have developed their own theory as to the cause of the financial crisis, one thing is clear, and that is that this economic disaster was years in the making. Now, there are a number of incidents believed to have caused the financial crisis of 2008. The first one is due to a period of deregulation, which enabled bankers to create highly lucrative financial instruments that ultimately concealed the level of risk. Secondly, there was a greater number of subprime borrowers that were created both by government policy and private sector self-interest. Thirdly, the repeal of the Glass-Steagall Act in 1999, which allowed banks to become more involved in riskier business that formerly was only the business of investment banks. Other causes for the financial crisis include lowering of federal interest rates, foreign investments in U.S. housing markets, and excessive debt in 2004 when the SEC allowed big banks to borrow more heavily against their assets, a point normally considered to be in the red line of borrowing. The crisis began due to exotic or flexible mortgage lending. Indeed, there were unconventional mortgages with high default rising, which are the equivalent to junk bonds for the housing market. House prices peaked and eventually crashed. Borrowers with inadequate income relative to their debt were devastated. They were counting on being able to borrow against a higher valued house in the future, or at least being able to flip the property at a profit. Instead, when the financial crisis came around, they soon began to default on their loans. Banks saw reduced cash flows. This was all mainly due to lack of regulation. Subprime lenders allowed to lend under monstrous credit practices and provided consumers with liar or ninja loans, which stands for no income, no job, no assets. Essentially, these loans offered no down payment, interest rate only loans, negative amortization, teaser rates, option arms with no limits or controls. So if you could not afford any down payments, you start off with zero equity in your home. Little did they know that after 2 years, the servicing rate would increase by 500% once he or she started paying high market rates and principal on an ever-increasing stock of mortgage debt. Unfortunately, the originators had no interest or incentive to warn the borrower of these predatory and deceptive mortgage practices, because they were getting a huge commission. Thirdly, foreign tax havens in the Cayman Islands, Switzerland, and Singapore were believed to have contributed to the financial crisis. The offshore world holds more than $11.5 trillion in individual wealth alone, representing $250 billion in lost annual tax revenue. Of course, every sovereign nation has the right to establish its own tax code, and Switzerland, with an estimated $2 trillion in lost tax revenue, has long refused to recognize tax evasion as a crime. Today, 75% of the world's hedge funds are based in 4 Caribbean tax havens: the Cayman Islands, Bermuda, British Virgin Islands, and the Bahamas. Hedge funds made their record profits from the offshore bases by taking long-term gambles with short-term loans. Risky funds were backed by onshore banks but kept off the books as they were repackaged and sold around the world. Under U.S. tax law, while tax evasion is illegal, a company is free to establish foreign subsidiaries in search of financial expertise and global reach, convenience, as long as tax dodging does not appear to be the sole reason for relocating. In any event, the sequence of these events contributed in one way or another to the financial crisis of 2008. The results were the Wall Street Lehman Brothers went bankrupt. Fannie Mae, the Federal National Mortgage Association, and Freddie Mac, the Federal Home Loan Mortgage Corporation, were seized in 2008 by the U.S. government under the Federal Housing Finance Agency. Lehman and Bear Stearns disappeared, and Merrill Lynch was bought by Bank of America. Goldman Sachs and Morgan Stanley survived by becoming regulated retail banks to receive liquidity assistance. How should the banking system be fixed? There are a number of ways the banking system can be fixed, and different economists have their own view. One is banks should be nationalized, or more regulation is needed, and others believe that small banks can help solve the banking crisis. There have been large banks believed to have been too big to fail and have proven to be the opposite. And lastly, executive compensation of bankers needs to be amended. CEOs are getting paid way too much money, and it was believed that this was one of the main causes of the financial crisis of 2008. The current U.S. rhetoric tends to avoid the word nationalize, as it is often implicated to socialism. The preferred nomenclature is conservatorship, as it was called in the case of Fannie Mae. Many skeptics argue that the government cannot be trusted to allocate capital efficiency. However, it is not as though the private sector did a very good job, hence the national crisis. Paul Krugman made a case for nationalizing banks. He said, "Banks must be rescued. The collapse of Lehman Brothers almost destroyed the world financial system, and we cannot risk letting much bigger institutions like Citigroup or Bank of America implode." Some economists critique that nationalizing banks would give the false impression that banks are insolvent. Others argue that the government has more to lose than gain. William Isaac, former chairman of the FDIC, referred to the time when the Continental Illinois Bank was nationalized in the 1980s. It was the country's seventh largest bank and deemed too big to fail. Unfortunately, the bank had made some bad investments. They purchased $1 billion in speculative energy-related loans from Penn Square Bank, which failed in 1982. The bank had also invested in Mexico and experienced a debt crisis when they defaulted in 1982. By 1984, the bank reported that the amount of money lost from non-performing loans went from $400 million to $2.3 billion. Prior to this news, the bank held $28.3 billion in deposits, and $20.7 billion were larger than $100,000, and thus not insured by the FDIC. Bank customers began to withdraw their money in panic and withdrew a total of $10.8 billion in 1984. So to stay solvent, the bank began to borrow money, $3.6 billion from the Federal Reserve Bank in Chicago. Then Continental Illinois received $4.5 billion in a line of credit from 16 of the nation's largest banks. The 10 largest banking companies hold approximately two-thirds of the nation's banking assets. At the time, the Continental had less than 2%. The FDIC estimated that 2,300 banks had invested in Continental Illinois. The FDIC announced a $1.5 billion capital infusion and offered permanent assistance to prevent the bank's failure. So the FDIC purchased $4.5 billion in bad loans to bail out the bank. Continental Illinois continued to operate under government ownership until the government exited its stake in 1991, and the bank was purchased by Bank of America in 1994. The old shareholders received nothing. All creditors and preferred shareholders came out whole. In the end, the FDIC lost a total of $1.6 billion. At the time, the FDIC had only three options: liquidate the bank and pay insured depositors, arrange for another institution to purchase the bank. In 1991, Congress attempted to limit rescues of banks by passing FDIC-IA, Federal Deposit Insurance Corporation Improvement Act in 1991, which allowed uninsured depositors to escape without losses. The failure of the Continental Illinois Bank changed the way the industry calculated risk based on the domino effect that one institution's failure can affect other industries and lead to economic disaster, which wasn't taken seriously until the financial crisis of 2008.